We're snorting cap rates and shooting up cash flow here at Deal Junkie. Welcome back to Deal Junkies. Mike's already lost it.
I have lost it. It's funny. I can picture Dane walking over into my chair while he did that.
Yeah, Dane. Don't go watch our shorts on Facebook where Dane's farting on Trevor. It's just these kids.
They're kids.
All right. I'm Gabe Johansson here with Mike Nuss, Trevor Howard. Today is a big day. We're going to bring you an episode. This is one we've been waiting to do for a while. The whole world has been waiting for 2 years for the market to shift. And there was only one person on planet Earth that apparently had the power and wisdom and skill to share this information with us. His name is Jerome Powell, also known as J. Powell. You know who this is, Trevor?
I thought you were going to say Mike Nuss.
Well, Mike's like the second most powerful person in the world. So J. Powell, everybody just leans on, everybody's trying to guess what J. Powell's going to say. The markets move on the things. So everybody is hyper-focused on interest rates. The Fed started hiking interest rates. We go all the way back to COVID and the whole transitory inflation. Everybody's heard this story by now. And so then they've got to start hiking rates.
Jay Powell is the head of the Fed or the Treasury?
Fed.
The Fed. He's
and
the chair.
He's voted in?
No, he's appointed.
Appointed by the president.
And he's one of 12 voting members of the committee, the FOMC.
Yep.
But he speaks for the committee. He is the only human being that speaks for the committee.
On behalf of the committee. Even though the other 11 come out and make comments.
Exactly. Yeah.
And the markets move to their comments, too.
Right, which is what makes me laugh.
Because they're not really the one making the decision. They have a seat at the table.
Exactly.
They're an important person.
They're less than 10% of the decision.
So he's employed by like J.P. Morgan and Chase and all these people, essentially?
Well, the Fed is a bank, private bank that was created by the Rothschilds and the Rockefellers and J.P. Morgan Chase. Correct. So they created the Fed.
Do those families still own the Fed today?
Well, I assume so. If you create it, you own it.
But the Fed is sort of a pseudo-governmental agency, correct? Like, I mean, they are the bank of the government.
They're the bank of the government. They were created at the same time the IRS was.
They don't print the money, though. The Treasury prints the money.
Did you not listen to our past episodes?
I'm learning. I'm going back and listening to the episodes, and I'm learning so much from Mike.
He wants to re-record that episode.
So we've been waiting. So rates went up.
Yeah.
And so how does this affect?
The pivot.
It affects real estate investors. It affects everybody, really. Your credit card rates went up. Your home loan mortgage rates went all the way to 8% at one point. Commercial loans topped out somewhere in the low 7s probably.
I got a car loan. When I pulled in, I was like, hey, dude, I got to refinance my car loan here in the future. Sweet.
I
was banking on that.
I have a great
point. What happened?
What do you mean what happened? They raised interest rates.
No, but you're saying...
Okay, so the pivot statement. So let's get back on track. Okay,
Trevor wants to know what happened.
So everyone believes there has to be a pivot, right? And so the pivot, if there is a defined pivot moment that then the headlines can achieve, it was today. And so the headline is, what did Powell specifically...
This is August 23rd, 2024.
Yeah, so this is his quote. "The time has come for policy to adjust. That is the pivot. That is the historical statement." And so when you guys got a really vague text from me this morning that said historical statement day.
You said how many times has this happened in the last
20 years.
20 years.
So how many actual historical statements we've had over the past 20 years. And so what did I write? I wrote 2009, 2019, 2020, 2021, 2024. And what am I getting at? Okay, so 2008, 2009, policy just shifted. So now we're buying mortgage-backed securities. We're expanding our balance sheet. That was a significant historic event. Everything between then and really 2019 was just the byproducts of the markets adjusting to new monetary policy, right? So they slammed the rates down. They created a bond buying policy.
This is quantitative
easing, right?
They didn't have that prior to the Great Recession.
So that's the historic statement. That's the timeline, right? There's the mark on the timeline. And then everything up until 2019 was just them trying to use the one tool, because interest rates were zero, So they were just trying to use one tool.
The one tool being rates.
No, because the rates were zero and
buying
stayed at
and
zero.
selling
Oh, you
bonds.
mean
Buying and selling bonds.
Okay, the quantitative easing.
Quantitative easing, right? So this is when modern monetary theory became the description of how we run our economy in 2008, 2009. Now it's bond buying is the control of the rates.
So that was a shift.
That was a shift. That was a historic statement that created policy for the next 20 plus years.
So you were talking about then in 2009 they come out, they announce quantitative easing,
Yep.
and then by 2019, what are they talking about in 19?
So between 2014 and 2016, the begin of, okay, we need to start tapering our balance sheet, right? So they grew their balance sheet.
Oh, taper tantrum.
Taper tantrum. Right. So they had the taper tantrum, and then the Fed they increased rates a little bit, and they started pulling back a little bit, and we started going into a recession.
And Trump got pissed.
In November 2019. This was November 2019. Inverted yield curve, boom, emergency meeting, slam rates down. One statement, we will back the bond market. Boom, in the yield curve uninverts. Bond market starts flowing, yields go down, everything's great. And we headed into 2020 before COVID as a really good economy, solid economy.
Best economy, arguably, of all time.
Yeah, you look at the market predictions in the January, like everyone had because I research these things and I do a big prediction, right? So everyone had a little bit of talk about COVID, little tiny bit of talk, and everything
in January,
and it was all minimized.
It was in China.
Yeah, and it was all minimized. So COVID wasn't on the. But if you go back and watch any prediction, real estate's going like all it was.
They would ask them like, when is the next recession?
Yep.
And everybody's answer would be like, we can't even see one. We don't even know how that would happen.
And so what people don't realize is COVID 2020 is a byproduct of 2019 and the taper tantrum just as much as it was of all the weird fucking fiscal policies we created. That's what people don't get. And so
Go dive into that a little.
Okay, so we're going through this taper tantrum. So we set a monetary policy. We're going to expand our balance sheet. And then they get to the point where in 2014, 2016, we need to make changes. We need to change the economy. We need to take the baby off the tit. And the markets didn't like that.
So money was moving too fast?
Yeah. However, this is new to them as far as using the tools in this way.
And do you think that they ever felt like in 2009 when they came up with quantitative easing, they would use it as long as they did? Or was it kind of more of this is a Band-Aid fix that we'll use temporarily and it ended up becoming more permanent?
That is a great question. One I don't know how to answer because, and this is why I love economics. At that period of time, I didn't know. I didn't know anything about macroeconomics. And so I can't really explain the context. Even though I was there and I witnessed it and felt it, I can't explain the context of the mindset. But what you can definitely see is clear is once they started the tools, you can't get off it. And that's how I base my opinions on the economics now.
That's why it's a historic statement.
Exactly.
Is because it started a new era
Yep.
of something we did not have before.
Yep.
So 2020, obviously, we get COVID. And then,
So let's go back real quick.
Okay.
Right? So that's the pivot, right? Okay, so that's a pivot. Like people love the word pivot. We'll just fucking go with it. So 2008, 2009 is a pivot in monetary policy. Trying to then taper is the next pivot. But we never, we did get there. We raised interest rates.
This is 2014.
This is taper.
Not buying the bonds.
Tapering the reduction of the balance sheet.
Okay,
so right now they're reducing the balance sheet. So slowly,
or
they call it the taper tantrum.
They let them run off. They're not rebuying them as they mature. They're not rebuying them.
Okay.
Correct. And then that process made the markets uneasy. The bond market's uneasy, and then it started slowing down and then inverted in late 2019. Then they just made a historic statement then, right? So they tried to adjust policy, and that created a tantrum, and then they made another historic statement.
So they recorrected.
It's
like, oops,
exactly.
We went a little too far.
You can compare 2019 to 2024.
Okay.
So let me, and we'll unpack that.
Right now, 2024, today's statement?
Correct.
Okay.
Today is 2019.
Okay.
Today is 2019.
So we're doing this is Groundhog's Day.
Yeah.
This
the
is from
difference,
5 years ago.
The difference between 2019 and today is we've been knowing this has been coming for over a year.
Yeah.
We've just been making bets based on changing expectations of when the statement would come out and what the statement would be like. And there's so much money in the economy now that wasn't back then that it's all been on the sidelines, ready to pounce, right? So we have record stock markets, but they're not that much higher than, right? So we have all this, we've created all this wealth. It's been taken off the sideline. So we've seen a decline, but not much of one. So we have a record, but not too much of one. But we have all this gunpowder. And so that's the difference between 2024 and 2019. But in 2019,
there's more gunpowder now, you're saying.
Exactly, correct.
Okay.
And that's why the Fed has been going higher for longer, because there's so much more gunpowder.
Because they're afraid if they release their chokehold too soon or too fast, that all that money on the sidelines is going to pour in, and we're going to go back to inflation.
Yes. And this is why I freaking love Larry Flint's statement of we've switched from a credit economy to an equity economy. The gunpowder is the equity. The Fed has it.
So you're saying,
and the private markets have it.
So you're saying that all the cash on the sidelines is controlling the expectations of where the market goes?
I'm saying the Fed, by higher for longer and not making a statement, has kept that gunpowder on the sidelines.
When you say higher for longer, what do you mean?
Rate, that's their statement.
But they're not controlling rates. They're just controlling buying and selling bonds.
No, they do both.
They do both.
Remember
they have their rates. The rates are at 5%.
It's the overnight rate, though, right? Is what
correct. Yes.
But it has an indirect and direct effect on everything around.
But that's been Powell's statement. That has been the Fed's statement, is higher for longer for 18 months now.
You know how Mike talks about one tool is the ratchet in your IKEA box and the other tool is like a jackhammer or whatever?
Yeah.
That's
the power drill.
The power drill.
Yeah.
The power drill is the bonds.
Bond.
Buying the bonds, being the biggest buyer of bonds in the bond market. So when they stop buying them or rebuying them, really, then now you have to go to the open market to compete for those bonds, and they may now it doesn't have as much of an artificial nuance to it, because now the true market has to dictate what the value of that
exactly. When the Fed steps back, the private markets control interest rates. And when the economy needs gunpowder, when the economy needs to go, the Fed steps in to the bond market to low interest rates for everyone other than banks. Before they ever used a bond market activity, they could only control rates for banks, which would have a trickle effect across the yield curve. When they implemented the bond buying policy in 2008, 2009, that's how they actually control rates for us as the consumers.
Okay, so I have something to say about your power drill and your IKEA tool. The historic statement that Powell made today wasn't that they were necessarily going to lower rates. He just said it's time for them to shift policy and focus on their dual mandate, the second part of their dual mandate, which is step one, control inflation, step two, keep full employment. So what he's saying is we have fought the battle on inflation and won. We feel that we are restrictive. We are sufficiently restrictive to the point where now we can start to play around with the rates. He didn't say anything specifically about lowering rates, when they would lower rates, or quantitative easing.
He actually hasn't changed his position from the previous 6 months.
It's just one sentence.
It's just one sentence.
It's like everybody's been expecting them to say this for over a year, and they just wouldn't say it because they were afraid if they did, everything would take off again. So this is what we've all been waiting for, was for them to go, like, it's official. We've won the battle on inflation. And whether or not we go into a recession or not, nobody knows. But we're going to now focus on the other side of our dual mandate, which is full employment.
So this is so beautiful because there's a lot of quotes that he said that are in this Bloomberg article I'll bring up. But this is literally the definition of a soft landing. It literally lined up perfectly for what the Fed wanted to do, especially when you look at timing with this symposium, because a lot of times these statements are made at the symposium. In 2020, they made a statement on we're changing our framework policy. We're when I've talked about this, where they're going to let the economy run hot, right? They're going to make an average over a period of time. Rather than guiding the economy, they're going to react to the economy. And that's what they've been doing, is reacting to the data. But here's his statement. Is the direction of travel is clear, right? Okay, we're no longer staying the restrictive course. We need to go less restrictive. So we're traveling less. That is clear. We're now going the other direction, aka we are now deciding to pivot. That is our policy at this time, is pivoting. But these next words are no different. The timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
Sure.
So it's the same thing.
Boilerplate.
But what clearly is, so my confidence has grown that inflation is on a sustainable path back to 2%. Okay, they're not concerned about that. The big key here is they talked about the job market. Called it what was the word I asked? Unmistakable.
So the job market. So this is like unemployment goes to 4.3.
Yeah. So here's the best quote. We do not seek or welcome further cooling in labor market conditions. The labor market, what happened was unmistakable. And here's the key: gunpowder. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
So
it's everything we've expected, right? They've been trying to get gunpowder, but while they've been trying to get their own gunpowder, they've had to keep, because there's so much equity, again, credit versus equity markets, there's so much equity out of there, they have to keep that off the sidelines. And so that's where their words have been so important.
And it's really important, I think, to distinguish the difference between what's happening now and what happened after the Great Recession.
Yeah.
After the Great Recession, it's like once you go to zero, you've got nowhere to run, right? And so, like, the way Logan described it to me, it's like they're in a car going uphill and they can't get traction, whereas now they're in the car coming downhill and they're holding on to the brakes.
Exactly.
And whenever they want to release the brakes, they can release the brakes. It's a lot easier to do that coming down the other side than it is when you're trying to make it up a mountain with no traction. So that's a good visual. So, okay, so going back to Jay Powell's comment today, he says basically this we're going to get lower rates, but to your point, that's the IKEA tool. That is not the power drill.
Correct.
But they may end up doing some other things with bonds. They just haven't talked about that.
Exactly.
They'll do that based on where the data goes. So you mentioned a symposium. This is the Jackson Hole. This happens once a year?
Every August. Yep. It's a 3-day event.
And this is their big meeting of the year?
Correct. This isn't like one of their decision-making meetings. This is a in-depth symposium of presentations. It's a huge conglomerate. Everyone who's anybody's there.
They're having their mastermind.
Exactly. But the Fed is meeting, and then they make statements. So like I example the framework change in 2020. They say we've been doing this for the past year. This is what the change was. This is how they announced it was for the past year. We've been studying all of the influences on the Fed over the past 50 years, and we've decided that it's not smart to try and guide the economy. And again, they talk about the 80s and the 70s.
Volcker.
Exactly. They talk about how guiding it creates volatility, and now they think that rather they should react to the data. And if you listen to them and you pay attention to these historic statements, then the noise, and then you see the noise in between you don't have to pay attention to.
But this is one of the problems. This is why they thought inflation was transitory, is because they were following data, but then they had some excuses for why it went up.
I think they had to say that because they had to complete their end of the fiscal monetary bargain.
Okay.
They had to bank the fiscal policies. And as the bank, you have to keep other banks solvent, right? Like they're not concerned. They're concerned about the banking system and the American consumer. They don't care about the stock market. They don't care about the bond market. They don't care about our asset values. The banking system, when we're going through this chaotic change of fiscal policy, has to be secure. How many free loans were how much plumbing had to be in place to get that money into the economy? You can't be cutting yourself off as you're doing that. Just like now, as they've been coming down the hill, they can't cut themselves off by making a date and watching all that private gunpowder and equity flow into the markets before they're ready for it. So, yeah, I think it's just they have to be smart in how they implement things.
Well, I think we're excited. I think this is, for at least in the commercial world, for a couple of years, we really feel like we've been on hold. We've been sort of squeaking some deals through here and there, but we haven't been at a normal level of transactions. Some of that is maybe presidential election, some of that, but I think a lot of it is just waiting for this day. I got a phone call from Paul Curley on my way in, and he was just like, Jay Powell said it's time. He's like, and by the way, when this started going south, I was like, oh my God. I remember sitting with Paul going, this can't last very long, or we're not going to survive. And I don't know if people really understand how hard the last couple of years were in real estate. It was tough.
Well,
tough.
Do you mean survive in terms of refinancing properties, or just
I
transact?
For me, just as a broker and a brokerage owner and an investor, like I felt like it was just a full frontal assault on me. Like,
well, revenues were down what, 60%?
Oh, or more,
or more.
Yeah,
Wait,
probably more, like
revenues were
80%.
down 80% on
Probably.
brokerages. You mean?
Yeah.
Okay.
You don't feel it because you're new to brokerage and you guys are kicking ass and taking names, but like this is not the market. One of the reasons you guys do so well is your approach to brokering, but the normal everyday retail broker is I mean, a lot of them are working at Applebee's. Like, I mean, it has been a tough 24 months.
And if you think about, you now frame NAR in the lawsuit, it kind of makes sense why they're so fucking panicky. They're PTSD from the market. And now they've got PTSD from change. And
we had a couple really great years, and then we had no business, and then now we get this whole, can you even get paid on a deal?
Yeah, I mean, exactly. So they're stressed out. Brokers are just about as stressed out as they can be. And as we've said, so I made this statement the other day on Facebook, which is like 2 reasons that that we won't have a recession, or we may not have a recession, is housing and government spending. So housing creates 18 to 21 or 15 to 18% of our GDP. And 3 to 4% of that makeup is from real residential investment. Well, how much residential investment has been down, right? So housing has been a drag on our GDP. And then the government spending, well, how many more spending packages are we creating? And what do you do to get elected? You bribe people, and then you follow up with spending packages. So we're going to have government spending. So, like, again, higher for longer, slowing down the economy. As the Fed, you can't just look at the gunpowder and you can't just look at the interest rates. Well, how much money is the government about to pump into the economy as well?
So your whole point of this is rates are coming down, right?
Rates will come down.
How long does that take?
Which what we're really talking about is the speed of money.
Yep.
It'll come down as fast or as slow as they want it to come down, but I believe that it'll go down almost as fast as it went up. I think that they will, as long as the data continues to show that the labor marketing is weakening, they'll continue to pull off of that brake pedal.
And you think they'll hover between 5 and 6%?
I don't think it matters. I think what matters, like, here's what causes the market to stop is uncertainty. Mm-hmm. This is what causes a buyer to say, maybe I'll hold off, right? Maybe it's an election, maybe it's inflation, maybe it's the banks. We could buy it today at 7% interest rate, but what happens in 5 years when I have to refi? It might be 18% interest rate. So having this in the back of your mind, that where this goes, we don't know where the ceiling is. We found that ceiling 6 months ago or so when they said, okay, we're done raising. And that was our first sign to, like, okay, we can sort of thaw this out a little bit and start doing some business, because at least we know it's not going to go further.
So am I naive that I just don't care?
Yes. No, you're blissfully ignorant, which is great.
Because you're super passionate about all this stuff, and I'm sitting here thinking, how does this affect my decision making? It doesn't affect my decision making process at all.
Yeah. Well, you didn't go through bankruptcy because you weren't aware.
Yeah.
I went through bankruptcy because I didn't understand monetary policy, and I didn't make changes necessary that I could have if I understood monetary policy.
But, like, our whole business model is long-term fixed rate debt.
Mm-hmm.
So I'm like,
well, as an investor, we're just always trying to buy deals in every market. But the problem is, in the markets that we've been trying to buy in, is we didn't have any liquidity, so there were no banks. Like, even today, you can't find a bank that wants to do a commercial loan. And we'll get in. I think in this episode, we're going to talk a little bit about how to get a commercial loan. But we've had to go to some really smaller credit unions or agency debt, get into Fannie and Freddie, like big government-backed money, to even borrow money. So, I mean, even if there are buyers and sellers that want to transact, and we do have price discovery, and we can get to a level where we get everybody on the same page, you got to go find a lender. That's something that people don't talk about often is they say, well, brokers are bringing a buyer and a seller together. Well, there's a third party you're missing. Unless they're paying cash, you got to go find the money. And that's what we're doing most of the time as investors is chasing the money, chasing the debt, chasing the equity.
And relative to seller conversations in that. So trying to go to a seller who thinks their building's worth $4 million, which it was.
And now it's worth $3 million.
Now it's worth.
They don't like that.
Correct. And you're trying to explain, well, here's the reason why it's worth $3 million. A bank would have given me a $3 million loan last year. Now they're going to give me a $1.5 million loan at $3 million.
And as long as your note's not coming due, and I wrote this up on the SMI apartment update, it's like if you have notes coming due, most people are asking for extensions because now is not a great time to refinance. As we get closer and closer, I think today marks kind of the turning point of where we will see this start to go in the other direction. But we're going to be another year or two before banks are actually lending. I think you'll see more credit unions come back into the fray. But I mean, this is why you want to get big enough to do agency debt, because government-backed debt, you can always borrow money. But really, I mean, you go to any lender today, any local bank, any bigger bank, and you try to put together a commercial loan, they'll want almost half down, and then they'll want another 25% in deposits from you. I mean, if you can come up with 75% of the purchase price of what you're buying, you might be able to get a loan. That's dozens of lenders right now.
And we're talking about the commercial world, and like in 29 and 10, that's how it was in the residential world. You could have you could pay cash for the house in the bank, and they wouldn't give you a loan on the house. And so that's the importance in what happened to the market. It crashed because lenders wouldn't release liquidity. And so that's what you've experienced, and why you are blissfully ignorant is because you've been able to thrive when there has been no liquidity. And so why this is important for you to understand is your whole conversation going forward is going to be a lot different with sellers, because liquidity is there, which changes your conversation. Your tool is less effective going forward. And so you have to start looking and bringing other tools into your strategy.
Yeah, now's a perfect time to do creative deals, seller carries, because the banks aren't there.
Right.
A few years ago when you could turn an apartment complex into cash in about 5 minutes flat, nobody really wanted to talk about being creative and carrying contracts.
I think if you look, I think it's always there, though.
It will always be there because you know how to hunt for them, but there will be no low-hanging fruit.
There's less.
There's a level, yes.
And you got to go, it's needle in a haystack. You got to go find it. Right now, you can go to every property that's listed on the market, and chances are you'll find a seller who's open to some level of creativity with you.
And that will change.
Because there's no deals. I mean, not a lot of deals are selling.
It's the only way to get one done.
So you got to decide, do I want 2021 pricing or do I want to sell my property?
Right.
And if I want to sell my property now and I want that pricing, then I got to get creative, or there's no way to get there as a seller.
Right.
So now sellers are starting to soften, prices are coming down, rates are coming down. We talked about it in the last episode how rates are starting to line up a little bit more with cap rates, and we're getting some price discovery. So it's funny because Paul Curley just told me. I said I think this is gonna flush me down the toilet, and he's like, I was like, this better be done in like 6 months or a year, and he's like, no, it's gonna take 2 years, and I'm like, no. I cannot make it 2 years. And well, here we are 24 months later. He's calling me going, hey, it's over.
So, and again, you were thinking from a brokerage perspective for you.
Well, yeah, I run real estate businesses. My entire living is based on real estate. Whether I'm an investor, I'm a broker, I'm a brokerage owner, or property management owner. Luckily, property management's fairly steady. Right. And so that sort of keeps that's the foundation that keeps everything rolling. But I mean, if I didn't have that, like the brokerage model doesn't really work when you're not doing transactions.
The brokerage model is anything but recession proof. Even though housing typically doesn't slow down as much in a recession, when you have the big slowdowns like what we've had, like you've seen a historical event and you don't even realize it.
So I'm just dumb. I'm just naive to like.
No, you're just inexperienced.
This is your first rodeo. That's all.
So to me, this just shows me like it doesn't matter that much because we've done more deals than we've ever done. We've been buying deals still. We've been doing it all, and everyone's.
Yeah. So here's the perfect storm. Let me explain the perfect storm. So Gabe explained it from the seller side, right? Like if you want to get your price, you have to do it creatively. But the other reality is not a lot of buyers will sign up for what you'll sign up for, right? Because you have this lens of a long-term lens of higher risk, higher leverage, looking at the rate over a period of time, right? Like you look at it from a strategy standpoint. A lot of buyers don't do that. A lot of buyers are just 1031s that come lump them down, right? They're not sophisticated. And so they want it to be simple. They don't want to take on excess risk. And so not only does that seller need to sell in this way to get their price, they have to sell to someone like you. And so that's a perfect storm for what you've been doing. And you'll still be able to do that, but it's just not going to be as easy.
Yeah, it's what's going to get the market's going to get a lot easier for normal brokers. It might be get a little harder for you guys. I think it's just going to be there's just going to be less when people can turn their properties into cash in 2 seconds. There's just less conversations to be had around doing deals the way we like to do deals.
Yeah, and it's the allocation, it's the alternative, right? It's just the yield curve. That's all it is. It's the alternative. Right? Well, why would I do this when the alternative is I have cash and I have freedom?
I just think we know so many ways to do deals. We'll use the different tools at different times.
You'll be fine. Yeah.
So here's the thing though. If it's hard to put a deal together, that means it's hard to be a buyer or a seller. And it's also hard to go out and finance a new acquisition. It's also hard to do a refi right now, right? Your appraisal is going to be lower. Your cap rate's going to be higher. You're going to get all the things that you don't want. So as a real estate investor, luckily, you don't have a lot of bills and you're a wealthy guy on paper. But if you needed to extract some of that wealth, what are you going to do? If you can't, you're not going to be able to sell for the price you want to sell at, and you're not going to be able to refi at the rate you want to refi at.
I thought about that because I ran out of cash. I had to sell some stuff, and during the worst.
But you sold your 1 to 4 unit because residential didn't take the dip.
Yeah. But it showed me how important it was to do value add strategies because then you're safe through multiple market cycles. If you have equity, you can because then you can worst case still sell at lesser than you would like to. But if you have equity within that thing because you did a value add strategy, you're protected.
Well, and even beyond that, to own larger assets that can be financed by agency debt so that you can tap agency loans in any market, any cycle, they're always lending.
Yeah, so I'm assuming it's good that we're doing all this stuff right now because now it's just normal to us that this is the level it takes to put together a deal, and now it seems easier.
Yeah, you found success in the worst market we've seen in 40 years. Congratulations.
Cool.
Look at he smiled. Yeah. Oh!
I can't smile. I've been trying to break a chapstick addiction.
Oh, dude, I've been there, done that. I used to carry ballistics.
To break a chapstick.
Dude,
I was addicted to it in high school.
I heard they put something in there.
Yeah,
to make
fiberglass and shit, dude. I don't know if that was true, but I was addicted to it.
I've been using it for 20 years straight, probably 40 times a day, and ChatGPT told me it's going to take me like 4 weeks of no chapstick to break it. It's going to be really miserable.
So what are you doing?
Just not using it until my lips start to be too painful where I have to put some on.
Oh, it
and
created.
So if I smile, it just rips my lips
it rips
apart
it
right now. I can't smile for the next 4 weeks.
Keep making Trevor laugh. I want to see this.
So let's wrap up the economics and get into the lending conversation. So what to expect, right? Okay, so and this is perfect segue to lending, right? Well, when we finally had a refi amount greater than 2021 a few months ago, we're at a point, rates are going to get to a point where people can refinance. And so when you talk about the GDP discussion of how much housing has to do with GDP, what do people do when they refinance? They pay off credit card debt so they can spend more. They go get lines of credit at Home Depot. They make home improvements, they start then spending money that's a byproduct of the housing market. And so then your cost of construction is going to go up. It's going to be harder to find your subs again coming up, right? Oh. Like that's what you need to prepare for you. And we're going to talk about a reposition in the next episode, right? Like that will be harder than it has been the past 2 years. So, and that's just, so you keep asking me, why do you want to know? Why do you want to know? So I can prepare. Like this is the time to now be prepared. You have to have your subs down. You have to have your processes down because liquidity is going to make everything harder for you.
And you want to start making moves before it's too late to make moves.
Yeah.
And so there might be a time if you ever did need to sell, refi, or do anything, you got to time that out. I have one comment about the refi market, something that I heard somebody say the other day. Nobody said this in the last 24 months, but we always talk about risk pricing. So interest rates do whatever they do. There's a spread. Typically speaking, historically, the spread has been lower than it is today. So we call that risk, thinking war in Ukraine, war in Israel, presidential election, assassination attempt. Like that's in our minds. Those are kind of the thoughts that are conjured up.
Mm-hmm.
But I heard somebody talking about one of the main drivers in their risk pricing, and the reason they want a bigger spread is because of the risk of refi. So you go into a loan and they know the rate is high enough and they can see on the horizon that the rate's going to drop. And the risk of refi means you're not going to make as much money on that loan as you need to be profitable.
Mm-hmm.
And so they have to have more meat on the bone for them. For a lender, there has to be more spread. It's not just, we're being greedy, which that's what I always go to, is they're just being greedy. But there's also competition. So one bank would say, well, we're a little less greedy than the next bank so they can get all the loans.
Yeah.
So, but why do all the banks? It's almost like they're colluding, but they're not. That their models show that the rates are going to come down, and those loans that they're putting people into today are not going to. They're not going to go as long. They're not going to go to maturity, or they're not going to go as far as they would have. And so you really got to bake in prepayment penalties and do all this other stuff. So once we get down to a rate where it's a more acceptable rate, to where it's like, okay, well, now we're at 5.75, and yes, the rate may drop to 5, but a lot of people are just going to stick with 5.75 rather than I'm at 7 and it drops to 5. I'm going to refi.
Yeah.
Right.
And this is the mortgage spreads conversation, which is now, okay, so there's an artificial bake up in it. And then, like, how do banks think about it? Well, they're making a 30-year loan with a 7-year expected payoff. Now they're making a 30-year loan with an expected 2-year payoff. So that's how they have to adjust for risk. And the reason I'm bringing this up is because mortgage spreads are what my mind's gone to. I'm quite confident that the Fed will not back up the mortgage market anymore going forward.
What do you mean?
They will not buy mortgage-backed securities. And my thesis has been that we always go to the historic mortgage spread of being 1.5 to 6% or whatever, 1.5. I don't think that's real. I think that's artificially low because of the Fed's implementation in the mortgage-backed buying securities.
What do you think the more natural
organic you need
spread?
To go prior to 2008, 2009 when the spreads were the private market and not the...
Aren't you saying rates are going to go up then if they stop buying those?
They already stopped buying. They're actually selling. So once they sell off their mortgage-backed security portfolio, they're done in the mortgage-backed security market. This is just my opinion.
You think they're going to end quantitative easing?
No. Oh, no.
Just mortgage-backed securities?
Just mortgage-backed securities. Because they needed to do that to get through 2008, 2009. And I think what they realized with COVID, they did too much. And that's problematic for the housing market because of now you have to have low interest rates to create affordability. And so now you're stuck to low interest rates because of where they got housing prices to. And this is where I love Jay Scott's conversation about the trend line on inflation over time with the trend line on housing over time. And he's saying the housing market's going to be flat until we get back to housing being in line with inflation over the long run. And the Fed can do that. And it makes sense for them to do that if they're concerned most about the consumer. Then you just don't buy mortgage-backed securities. And so then you don't add gasoline to the housing market.
So as investors, you're saying you shouldn't buy solely for appreciation based on it's just going to go up. You're thinking it must be a value add. You can force the appreciation.
I've
and
always said that. I've always said that.
Except you were wrong because houses doubled in value.
No, I'm not wrong. That's just where you become wealthy.
Yeah. You're just saying don't buy for that reason.
Yeah, exactly.
When it happens, celebrate it, but don't bake that into your model.
You want forced appreciation. This is why I don't believe in Bitcoin for me right now. It's because everything I buy is forced appreciation. So, like, for me, high leverage is a short period of time because I'm going to buy it, and in 6 to 12 months.
The value. You already know going in.
Exactly.
You're not going to be highly levered in 6 months because you
refinance back out.
You implemented your business model.
Exactly. And so that's what I want to buy. You don't buy on appreciation.
I buy on appreciation.
That's what I'm saying is you can do it, but you're not every buyer. And I would do what you're doing. I would structure them the way you're structuring them.
If you're forever hold, you're
correct.
We know they're going to keep printing money.
Yep.
We know they're going to keep spending money. We know they're going to do all these things because they have to. And so asset values are just going to go up over time. They're going to go up and down. We're going to have the dips and the valleys that we've had recently.
And again, blissfully ignorant. Like, I never knew any of this, so I set pace on this small asset portfolio that now it takes management, right? It takes all these tools and resources where you just got to get into the world. Now, big assets, you track different So
moral of the story, just buy stuff with long-term fixed-rate debt. and then turn this podcast off and stop listening.
So let's segue into
No, but that's
commercial
not
loans.
fun.
Let's talk about commercial loans.
Okay,
Yeah.
Because I think that a lot of our listeners want to know more about the commercial world we play in, and it is different than residential. Residential
Absolutely.
money is fully amortized, 30-year money. It's very, very safe. Usually the interest rates are lower than what you get on commercial money. Not always, not right now. But the biggest difference in a commercial loan is they term out. So even though a commercial loan may have a 30-year AM, some of them have 25-year AMs if it's an older building. There's going to be a call where the loan has to be paid off. 3 years, 5 years, 7 years, 10 years, most of them.
Typically,
right?
yeah. Typically, you're looking at 5 or 10 years on a stable asset. You can do bridge debt for 3. Agency will give you full term, right? 30-year notes, correct?
I think typically they'll term out at 15 and go to some sort of arm. A lot of the loans products that we see today are like 5+5s.
Yep.
So it'll be 5 years at a fixed rate, and then they'll reprice you 5 years in and adjust your rate, but
Yes,
not give you a balloon.
but it won't go to an adjustable rate. It'll go to a new fixed rate that's already
Predetermined in the loan doc.
Yeah.
And that's a change from the economics of it. They don't want to do 10-year loans, but as a borrower, you need a 10-year loan.
Yep.
And so that's the cure to that.
So, yeah, the biggest difference for people trying to get into commercial is they're not looking at you as much as a borrower. When you get a conventional loan, 1 to 4 units, that's not a DSCR loan, they're looking at you, your DTI, your debt to income ratio.
Your
how much
ability
money-
to repay.
Correct, just you as an individual. When they look at commercial properties, they're looking at the property's ability to repay for itself.
Unless
they
it's
also look at your credit score, net worth, and your
Yeah.
history.
And that's is where people don't understand. And these are the details that people want to hear from us is your real estate schedule. How important is your balance sheet and your real estate schedule to commercial
It's
borrowing?
everything.
They want to see that you have done this before.
Yes.
And if you haven't, you can solve the problem of bringing on a partner who has and has the net worth if you don't qualify on.
And this is where marketing. So just going into the gurus that sell stuff. Oh, and Grant Cardone. Don't gotta buy a 1 to 4 unit. You got to get 5 unit plus. Those loans are easy. Those loans are just on the property, which if you have no assets isn't true. And then that's how they get people to bring them deals because they need a partner.
I will say getting a $10 million loan is way easier than getting a $500,000 loan.
Yep.
The problem is when you go get the $10 million loan, they want to know how many other $10 million deals
Right.
you've done. And so if you've never done one,
Right.
it's going to be hard because they're looking more at track record. They're banking on the property making the payment
Right.
to them, and they want to know that you're not going to run that property into the ground. Typically, they want to see from us that we've signed a property management agreement. They want to vet the property manager. They want to see a business plan. They want to know that we understand what we're doing when we get into run that deal. But it's very much like I could be a 350 Beacon score and go get $100 million loan,
Right.
as long as my balance sheet and my financial statement said.
I don't know if that's true.
I think there's guys out there doing it.
Yeah, but here's the whole thing to that. The process, that loan is much easier for you because you've gone through the whole entire process of getting all the experience that they want to see because that's how you get to where you're at.
And so that started with a duplex and
Yep.
then a triplex and
Exactly.
then a fourplex. And
Yep.
eventually, if you own a couple of plexes and you want to go buy a 10 unit, they're cool. If you want to go from a fourplex to 100 units, you better have a partner that's
Right.
done it before or some other plan because it's probably not going to work. Even if you're a sponsor and you're raising the money elsewhere, you still got to show a resume that you know how to run a 100-unit deal.
Yeah, and then the biggest thing too they're looking for is net worth equal to loan amount is another general metric. It's not exact, but they're looking for
It's
that
it's
ballpark.
one of the first sniff tests they do on you.
Yes.
Is your net worth higher than the loan you're going for? That if it's not, it's like we're not going to dive much
yeah.
deeper.
Yeah, and then the biggest thing they're doing for lending is they're not just giving you a 75% loan. They're looking at the property performance and they give it to you based on DSCR, debt service coverage ratio, making sure that every dollar the property makes on NOI is typically 1.25 times greater than every dollar of principal and interest, and then they just adjust your loan amount until you hit that.
So they're taking your net income and shaving off 25% to be safe, and they're saying that's what your max payment can be, because we know that even if the property takes a dip in income, we're still going to get paid.
Correct. And then for people listening, that's why loan amounts decreased in commercial because interest rates went up, your property income stayed the same, and now your debt payment is higher, so you can support less debt with that same loan amount. So they lower the loan amount to lower your monthly payment.
Yeah, you don't get as much bang for your buck in that payment because too much of it's going to interest. So you get lower leverage loans. That's why we went from 75, 80% loans to 55, 60, 65% loans.
On the way here, I just was loving listening how you talked about neutral rate and neutral leverage. Yeah.
So for people trying to get into these, like, explain the process. If someone's buying small plexes, they want to go buy a 12 unit. What does that loan process look like?
So I'll give you my take on it. I think that once you get into that commercial world, maybe when you first start out, it's going to be relationship driven. So my advice would be, if you're a member of a credit union or you've done some other loans with smaller community banks, go to them first and find out if they would approve for you to buy a larger property. That's one way to do it. Once you get into doing more deals and bigger deals, I feel like you really need to have debt brokers. And I'm lucky that in all my partnerships, I have partners that sort of act as debt brokers. But one thing that people need to realize is when you go get a residential loan, there's not a lot of back and forth negotiation. It's just this is the loan we'll give you, and you say yes or no. On a commercial loan, usually they're giving you multiple options, and from there you can sort of massage it and negotiate. We've heard Logan DeVos. If you haven't listened to Logan's episode, go back, to the beginning when we started this podcast. Listen to Logan talk about negotiating with lenders. Like, you can actually negotiate it just like a real estate transaction and say, well, this loan doesn't quite fit what I'm trying to do. I'm looking for more leverage or longer term, or I want the prepayment penalty to burn off sooner. So there's a few ingredients that go into baking a commercial loan, and all of those things are technically negotiable.
Yeah, but to get started, like, if they're going to go get a loan.
Well, I mean, so first off, you've got to build a financial statement.
Yep. So PFS. So
we call it personal financial statement, PFS. SREO means Schedule of Real Estate Owned. So go ahead.
He answered your question. You build a relationship. And so I'm in the process. Yeah, so I made the mistake. We moved all of our banking over to First Republic with the expectation that that's going to open a whole bunch of lending to us.
And now it's Chase. But even the process of then getting loans from First Republic they were really fucking conservative.
Yeah. So why was First Republic actually tried to be bailed out? Because they were ran pretty damn well. Their loans were like, really? This is the leverage you're going to give me? This is really? This is the product, and I have all my wealth here, And so going and applying and showing them your personal financial statement, which Gabe can get into, going to the bank to create a relationship and get feedback on that personal financial relationship. And so, for example, now because it's Chase, I'm looking for a better banking situation. I've had a banker I've been building a relationship with, so we went and got 2 commercial loans, multifamily property loans from them to see what the process was like. How did they negotiate with us? What were they, right? So now you can see, is it really a relationship? And then is it because to get the loan, you need to bring your money there? That's where they want you.
Right now, yeah. You heard me talk about my resentment against banks right now. They want to be relationship lenders. Mm-hmm. And that relationship means they want you to make a bunch of deposits, and then they don't want to give you any loans. So
but in other markets, it's not. You don't have to have that level.
So I will say right now, if you're listening to this and you're going to go out and look for your first commercial loan, it's going to be very, very hard. So just be prepared. Like, you may have to talk to 50 lenders before you find one that says yes. This is what Trevor was doing, by the way, when he found me. He was going around sitting with lenders and asking them if they would loan him money. And
yeah, so I think this is a good example because I didn't have the net worth to get that loan for a $2.5 million complex at that time, but I had it under contract to buy, so I had to figure out these steps on how do you actually get a commercial loan. And I had zero idea how to other than podcasts.
And most people that are not Trevor do not go put a $2.5 million loan under contract before they understand how to go get a commercial loan. Therein lies what makes Trevor different than most people. I would not have the guts to do that. So you went out and you tried to find the money. You're trying to solve the problem, and people are sort of laughing you out of the office. They're going like, yeah.
I could get the meeting on the front end because I would just send them an email with some questions. They'd be like, and I knew the lingo, I knew the generalities of it. So they're like, great. Then I'd go to the meeting and then be like, I'm not going to give you this loan.
And you felt it was because of your age. I think it's probably just more you're background, you didn't have the resume, you didn't have the balance sheet.
Yeah, I didn't have the necessary requirements. I was trying to understand what they were.
Well, the world has been telling you this is an easy loan to get. You have been thinking this is easy. It's a commercial loan. It's asset-based. It's based on the property. This is a great deal. Why will you not give me money? And the reality is it's not the deal. As much as it is the deal, it really isn't the deal.
So there's two aspects to it, because there is the deal and the leverage and what they would give you. So I knew from that perspective I could talk to them on the front end. You will give me this loan because this is where the property DSCR is at, and here's what I can do with it. So like, great. But I did not have the net worth or the experience. I'd only bought houses and a few small plexes before I did that deal. And I was worth, I don't know, $100,000 maybe. Right. And now I'm trying to get
$2.5 million.
Yeah. I'm trying to get like a $1.8 million loan on this thing. So
one thing I will say, a residential loan, residential lenders for the most part are always lending. Like, you know what you're going to get. You're buying 1 to 4 unit. They're going to get an appraisal. They're going to underwrite you, see how much money you make, see if you can make the payment. It's kind of simple. So residential lenders, for the most part, always have access to money, can always lend you money. When you get into commercial, it changes. So you may have a lender you've done 3 deals with over the last couple of years, and you go back for a 4th one, and you say, high five, let's rinse and repeat. And they go, sorry, we can't do this. Things change on their balance sheets. Sometimes you have too many loans with them, and you do have that relationship, and now you've created a new form of risk for them because they have too many eggs in one basket loaning you too much money. So most banks and credit unions have fairly low loan limits.
You find it's around 15 mil to 20 mil. Right?
I find really it's more like 8 to 10 usually, but sometimes, you get into 15 plus, you're in pretty good shape. Now you want to go Wells Fargo, who doesn't loan any money, Chase, who doesn't loan any money. You can go to these places. They'll give you a 50% LTV. They'll give you an 8% interest rate today when you can get 5.5 or 6. But, you're going to get the worst loan possible. It's not going to be competitive whatsoever. However, you go to Chase and you want to do $100 million worth of those, sure, no problem. They might have almost no limit on you, right? Because they're big enough to absorb that loss if one person goes down, and they've got, their buckets are just a lot bigger than everybody.
And they need to place it.
So when you're out, it's really, really important. This is one of the reasons why I usually talk to debt brokers or one of my partners who's smarter than me, is you don't know. First off, every asset lines up a little different, and every bank and every lender, every credit union has a different appetite for different markets, different asset types, different asset sizes. And so you may not be able to take your small storage unit complex in a tertiary market to the same lender that you would take a 50-unit apartment complex to in a secondary market. So there's a little bit of a puzzle here that has to be solved. And here's where it gets really, really crazy, is you may know exactly who the lender is for that market and for that asset type and asset size, and then you show up on their doorstep with an application, and they go, we're not lending right now. And actually, they won't tell you that. They won't tell you they're not lending.
Until you get to the closing table.
They'll wait 30 or 45 days and pretend like they're underwriting your deal, and then they'll tell you that they won't. Typically, what I've found is that by the time they let you spend money on an appraisal, you're probably pretty good. They don't feel good about you going out and spending thousands of dollars on an appraisal until they know they've either got you approved or they've got you somewhat pre-approved to where they feel like they're going to do this loan. The problem is when you're chasing commercial debt and you're 2, 3, 4 weeks into this and you're going, can we order an appraisal? Can we order an appraisal? And they're slow walking you. You know what's happening behind the curtain. And this is what gives me so much resentment against lenders, is they don't just come out and tell you they're not lending, because they can't.
Right.
They're not allowed to say that. And even their people that are their salespeople trying to bring you in don't even know. The people behind the curtain who are watching the balance sheet and knowing where the money's coming, where it's going, and how much is on their credit lines and how much they can borrow, that changes day to day. It even changes with Fannie and Freddie. Like Fannie, you don't tell Fannie when you're going to close a loan. They tell you when you're going to close a loan, because the way the money flows, it all happens behind the curtain. So I would say it's very, very, for me anyway, it's very, very difficult. I understand I buy in certain markets. I understand which lenders are in those markets. I understand how big of a deal somebody will take. Typically for me, I find a really great lender and I tap them out in the first few deals, and I got to go again. So this is why I say we're not really real estate investors. We're just money chasers. Like we are constantly looking for we're constantly looking for seller carries. We're constantly looking for investors. We're constantly looking for lenders. We're always looking for the money, because if it were that easy, like I could just go and say, well, I just do all my deals with Chase. That'd be an easy way to do it if I wanted to buy 50%
Yeah, if you just wanted to acquire real estate.
at the worst loan rates that you can possibly get, right?
Yeah.
The other difference with commercial loans, too, is how long it takes to close. In the residential space, you're doing these things in 30 days or less. Commercial, you're 60 to 120 days.
I say the average I don't know, multifamily. I'll just speak to multifamily. I think the average deal takes 100 days. That's what you can plan on I think 100 days is a safe bet.
What about like bridge debt? Can bridge debt move faster?
Oh, sure. But you know what's funny? Bridge debt, that's like Band-Aid money. This is hard money, or you know, maybe not. It's a little softer than hard money, but you know, a lot of bridge lenders will tell you, you know, up front their pitch is we can close a deal in 2 weeks. Bullshit. Like you can barely get a title report in 2 weeks and like get everything under
financial.
I mean,
yeah, exactly.
Sure. Like if it were the cleanest deal on earth, maybe they could pull that off in 2 weeks. But my experience is even on bridge debt, you're probably looking at 2 months.
Banks just don't care about your timelines. On the deal we're doing right now, they said they would close 2 weeks after we got an appraisal. Appraisals due back September 1st, and now they're like, okay, we'll close sometime in October now.
Yeah. Well, September 1st to mid-October is about 2 weeks for a bank. Their calendars are different than ours.
Yeah.
So why do you think that is? I mean,
they want your business on the front end. They know you'll probably extend, not their problem. They're not spending dollars also because they take good faith deposits. So you're funding them doing all that work.
So are they waiting for their borrowing rates to drop? Are they looking for their balance sheet to sort itself out?
I think they're just doing so many things at once, and they're not super competent half the time, depending on who they staff, that just falls to the wayside. Most of the people working there, right, they're going to a job that they don't care about.
Well, they've already underwritten the deal. They already know what the deal is. Now they're going to get an appraisal. The appraiser is going to give a third-party analysis to back up support whatever valuation, right? And so now they're going to read the appraisal, and they're going to read our business plan, and they've already sort of pre-approved us as borrowers, or we wouldn't have ordered an appraisal. Most lenders truly can close a deal in 2 days once they have the appraisal, if you really push them. For somebody to say we're going to have our appraisal back on September 1, we're going to close 6 weeks later, I will say that there are some lenders that are small that get overstaffed, that have too many loans in their queue, and they can't push a deal through in a week or 2 weeks, and they need more time. But that's the only logical reason why, unless they're trying to back out of the deal, that they need 6 weeks to. I mean, who's going to sit? You don't read an appraisal for 6 weeks.
I hope we have the money ready for you in 6 weeks.
They're moving things around behind the curtain.
And this is, again, where now knowing all your lenders matters, right? And so, for example, the care facility, the appraiser needed some information. It's delayed. Now the appraisal is going to be on the 6th. Well, we still have 24 days to close it. I'm not concerned because I know that lender can get it done with that period of time.
But these guys, they'll put us in a tough spot because we'll have to go release earnest money or put in more earnest money. I mean, I've had deals where I've had hundreds of thousands of dollars released to sellers, and the lender doesn't really care.
Right.
We've had lenders back out on deals where we had earnest money already released. In that case, I'll say that it's a benefit because you've got skin in the game at this point, and usually a seller is going to be more reasonable with you. And if they try to fail the deal and not let you move forward in good faith, you have a case for there's damages. I mean, I've got $200,000 in your pocket. You don't want to give me another month to go find a lender because this one backed out. It's like, now we could end up in court or something else could happen. So and you have a valid lis pendens on their property to tie it up. Yeah, and I'm always super careful about advising clients to release earnest money, but I would just say from my perspective, I'll do it on purpose, knowing that it really locks down a seller if I want that deal. Because if you don't have hard earnest money, it's very, very easy once you end your timeline just for the seller to go, you're not going to perform. We're moving on to the next one.
So I'd say to close it out, let's simplify it for what someone needs to do if they want to go get commercial.
Build a financial statement, build relationships. If you don't know about this, go see Trevor and get a class on building a financial statement.
No, so you're going to actually build out your PFS, your balance sheet, all your assets, all your liabilities. You're going to put together your SREO, which is going to show how all your properties are performing that you currently own, what the debt is on every one, when you acquired them, all that information. Then you're going to start talking to banks before you even have the property, so you know which banks are lending.
That'd be ideal.
And see what piece you are missing. So I would present that information to them, say, I'm looking for a property and about this loan amount. What do I need to do to get it? And see what you're missing. Once you have the property and all those pieces that you're missing, you put it under contract and you're going to send that to the bank. You're also going to send a package to the bank, an executive summary.
What's an executive summary?
I'm getting there.
Oh, okay. How do you build one? Tell me every single step in building an executive summary.
So it's just a report of how the property is currently performing, what you're going to do to the property to make it better. It's just think back in high school how you would write a report, right? You're going to outlay the whole plan of this and tell them why this is a good loan to give you.
This is a 10-page report with some
6-page
pictures.
report, what the property looks like.
A spreadsheet, and your write-up on
why it's worth this much, how much it's going to be worth when you're done doing X, Y, and Z, how long it's going to take.
Can you just Google executive summary and it'll tell you how to do it, or do you have to?
Probably, yeah.
You have templates you would share?
Yeah, we have templates. We'll just give you ours, and you can go copy and paste data in.
So the answer really is on a commercial loan, they're underwriting you as the borrower, really more as the operator, and then they're underwriting the asset. But it really, the bigger that the asset gets, the more it is heavily underwritten on the asset, not on you as the borrower.
Correct.
But if you don't have
your net worth and track record, if you don't have the net worth and track record,
you got to bring in a partner.
Go find a partner who does. You're cleared. You're good to go. You got to have the liquidity to close the loan, plus about 6 months reserves of principal and interest payments.
And that's why Trevor brings me in on deals.
Yeah, because I can qualify.
He wants to do bigger deals than he qualifies.
Yeah, and that's what people do. There's so many GPs across the nation where they just have a guy sign because he has a big fat balance sheet.
We call him a KP, key person.
Keepers.
Yep. And then what are the next steps after that? I mean, that's about it, and then you're starting the loan process.
Yeah, I would say here's the one bit of advice I want to hammer home is it's really a shot in the dark to think that you're going to go walk into the exact bank that's going to be lending at that time that likes you and the asset that you're buying. You need help. Like maybe you can make some phone calls or whatever if you're super smart. And there's a lot of people listening that are way smarter than me. I'm sure you can do this yourself. I just really feel like you need somebody on the team. If you don't have somebody on your team that understands who's lending right now and what type of assets they're looking for, it starts just like a real estate deal. What is it? You're solving a problem for the lender. They have money to lend. They have certain tranches they're trying to fill. And even in when they have plenty of money to lend, they may go, we've got too much in multifamily right now. We're looking for something else. I mean, a banker basically, their whole job is to mitigate risk. That's all they do every day is try to mitigate risk.
Can we go to a bank and find out where they're lacking loan activity?
I think so.
Yeah.
I mean, I go to lunch with bankers every week.
Yeah.
I meet with them all the time, and I have the same conversation over and over again, which is really, really boring. But it comes down to like, will you do something special for me? And the answer is always no.
But like if you can get a banker to say, yeah, we need more self-storage loans in our portfolio, go find a self-storage loan, we'll get you a good deal.
Yeah. I think the problem is that the front end people are always going to be like chomping at the bit. Like, yeah, Mike, we want to do loans for you. Bring us whatever deal.
Yeah, so I'm talking about how do you get to the guys that are on the committee, the voting, the loan approval committee,
decision makers,
because they're looking at their balance sheet and they're looking at their charter and they know, hey, this category we're high in, this category we're low in.
I think you got to become a big borrower so you can have more sway.
Maybe. It'd be really fucking cool and have a great podcast.
Also, yeah, that's good. That's a good idea. I will also say that you can find a loan officer who gets to underwrite their own deals.
Yeah.
And now they're sitting at a table that some of the front-end salespeople are not normally sitting at.
What he means by that is they're looking at what the debt cover will be on this deal and what kind of loan they can give because they're smart enough to do some basic math. And everyone selling you the loan on the front end has no clue, and they'll tell you can do a 75% loan, and then once they underwrite it, it's 60.
Yeah.
So you have to understand on the front end, and you got to tell them, no, you'll give me, this is the loan that it qualifies for in the ballpark.
In an ideal scenario, in a great relationship, is being able to have a head underwriter or someone that can talk to the decision maker and give them property financials during the negotiation.
Yeah, there are small enough lenders out there that there are people working for them that are doing loans, have the ability to rubber stamp a deal and approve it up to $1 million, $2 million, sometimes even $3 or $4 million. So when you find those people and you build those relationships, it's really, really key, because you can get rid of a lot of riffraff. They can look at a deal with you and in a couple days tell you if you should keep going down that road with them or not. The biggest frustration you'll have is when you think you've landed a deal and you're 45 days in and you're wondering why the appraisal hasn't been ordered, and then they come back to you and tell you, yeah, we've decided this loan isn't for us. And now you're supposed to close in 2 weeks. Usually you got a 60-day closing window. You got 30 days extension maybe baked in. And so now I got 6 weeks to go find another lender and get a deal closed, which isn't going to happen.
Mm-hmm.
And this is why deals take 100+ days to close, because oftentimes you're out chasing multiple lenders.
Yeah. So what have we learned? We've learned that asset-based, property-based loans only set up the terms of your loan, but have nothing to do with whether or not they'll give you that loan.
That's good.
Yeah.
I like that.
So getting the money, the terms of the money is defined by the property, but actually getting it has nothing to do with the property.
And once you get bigger, this gets easier, and it really, truly is. Like today, for me, it's easier to get a $10 million loan than it is to buy a house, because when they try to underwrite me as a borrower, they don't understand me anymore because I have too many things going on. It's really, really hard for me to get a small loan. But I want to go do a big deal, and they go, oh, yeah, he owns other stuff. He knows how to run a deal like this. It's super easy, because they know the asset's going to pay them back. When they underwrite me for a house, it's like,
I don't know. This guy used to be an addict. He's got a podcast called Deal Junkies. Do we want to give him a loan?
Well, they look at it and they go like, you lose too much money. It's like, no, that's called depreciation. They're in real estate. They're underwriting a loan. They don't know what depreciation is.
I know.
Now, you're getting me all wound up here.
Sorry. Let's wrap it up. It's a long episode.
All right. So share us. Are we going to give anybody a shout out on this? Do you want to shout out a lender, your favorite lender? Somebody.
I hate them all. Hate them all.
We're sorry to our lenders we do love who are listening to this right now. We're just wound up.
That's so bad. And
Any
funny.
debt brokers? Nobody?
Oh, so I got a question. So you talk about your capital team. Is that debt brokering?
No, we shut it down.
Oh, you shut it down?
Yeah.
Oh.
We didn't do any loans for the last 2 years.
I mean,
They shut itself down.
we broker all the debt essentially for all the clients.
That's your role in what you do.
Yeah, we have multiple debt broker. It depends on the loan type, and if you need help doing it, we can help you guys find the loan type that makes sense for the deal type you're doing.
Or connect you. I mean,
connect you.
There are good debt brokers.
There are. There's good debt brokers out there. They fluctuate throughout market cycles.
So does this mean you're going to start that back up? Deals will get done?
I want to start a debt fund.
A debt fund.
If you're listening to this and you want to broker debt and you want to raise money and do all that, there is potential opportunity for you. Reach out to us.
We have
Deal Junkies.
We have shiny object syndrome.
We need help.
No, that's a supplemental business
All right.
opportunity.
Let's close out here.
Yeah. Fuck, it's long.
Give us a favorite on the podcast. You can go.
What's that
star it.
mean? Oh, hit the star.
favorite?
We should
A
probably learn
star?
what it means. I think you can.
I think you hit the little heart.
Hit the plus
The
button.
heart, the plus. Do
Forward,
the-
share, tag us.
Go to your screen right now and hit all the little buttons at the bottom of it.
Make us feel like we're worth something, please.
All right. Thanks for listening. We are the Deal Junkies, and we'll see you next time.